Why Starbucks almost failed in Australia. Imagine the most famous coffee brand in the world, one that had already conquered thousands of street corners across the United States, suddenly opening dozens of new stores in one country, and then overnight, shutting down 61 of those stores all at once. This isn't fiction. This is the real story of Starbucks in Australia, a country that, surprisingly, nearly defeated one of the most dominant brands on the planet. In this video, we're breaking down why the exact expansion formula that worked so well for Starbucks in America completely failed when it was applied, unchanged, in Australia. And by the end, we'll see just how much this story mirrors another global business failure you might already know. Walmart in Germany. Starbucks officially entered Australia in the year 2000. And what happened next was aggressive, to say the least. Within just 7 years, Starbucks had already opened 87 stores across the country. On paper, this looks like a massive success story. But the reality was very different. Starbucks then closed 61 of its stores at once, suddenly revealing a serious market failure underneath the surface. What's interesting is how differently Starbucks entered Australia compared to how it built its business in the United States. Back home, Starbucks grew organically, city by city, letting market demand build naturally before moving on to the next city. In Australia, that approach was thrown out entirely. Starbucks opened stores everywhere as fast as possible, before Australians had truly gotten to know or developed any attachment to the brand. And this is where the real trouble began. The first critical mistake was the strategy happening in the wrong order. In the United States, Starbucks built brand awareness first. People got to know, talk about, and grow to love Starbucks before new stores expanded into wider locations. Demand grew organically, city by city. In Australia, this entire sequence was reversed. Starbucks stores popped up everywhere, downtown, in the suburbs, in various strategic locations, before Australians ever had the chance to build an emotional connection or even basic curiosity toward the brand. Imagine opening dozens of stores for a brand that, for many Australians, still felt like a complete stranger. There was no story built up beforehand, no curiosity cultivated in advance. The result? Extremely weak consumer interest from the very first day those stores open. This is the most fatal mistake of all. Starbucks underestimated a coffee culture that ran incredibly deep and had already matured over generations in Australia. This culture wasn't built in a matter of years. It was shaped over generations, carried in by waves of Italian and Greek immigration that brought espresso traditions to Australia long before Starbucks even existed. Australians were already accustomed to high-quality coffee, made by skilled, trained baristas, held to very specific standards. They had their own terminology, their own preferences: flat white, long black, cappuccino, espresso-based drinks crafted with precision. This wasn't just about taste. It was about craftsmanship, ritual, and cafe culture that had already become a natural part of everyday Australian life. Starbucks arrived with a completely different menu: sugary drinks loaded with syrup, oversized American-style portions, built around a grab-and-go mentality. Buy fast, walk away. This was the total opposite of what Australian consumers valued. To them, this wasn't a quality coffee experience. It felt like an oversized sweet beverage being sold under the label of coffee. Starbucks didn't just lose on taste. Starbucks lost because it failed to understand that for Australians, coffee carried a cultural meaning far deeper than just a caffeinated drink to take on the go. Beyond the cultural mismatch, there was a more concrete problem. Starbucks' menu and pricing simply didn't fit local market expectations. Starbucks' signature sugary drinks, oversized American-style portions, and premium prices were seen as inferior compared to coffee from independent local cafes, coffee that was more affordable, yet considered far higher in quality. Picture this from an Australian consumer's point of view. They could get expertly crafted coffee from a skilled barista at a lower price, right at the independent cafe on their own street corner. Then there was Starbucks, selling coffee widely seen as less authentic at a higher price. Which option would they choose? The answer was already obvious. What made Starbucks' position even harder? Even consumers who genuinely wanted an American-style coffee chain experience had a better alternative available to them. That alternative was Gloria Jean's, an American-founded coffee chain that had entered Australia earlier and, crucially, had already adapted its menu to local tastes. Gloria Jean's managed to build a strong presence in the Australian market precisely by doing what Starbucks had failed to do: adapt. With this positioning, Starbucks was essentially squeezed between two forces. On one side, local cafes that Australian consumers already deeply loved and trusted, and on the other side, an international competitor in the same category that was simply smarter about adapting to the local market. Starbucks had no room left to win on either front. Over its first 7 years operating in Australia, Starbucks lost more than 105 million US dollars. This figure was so significant that the Australian branch required substantial financial support from its parent company in the United States just to keep operating. Then the 2008 global financial crisis hit, accelerating Starbucks' decline in Australia. But it's important to be clear, the crisis did not cause the problem. It simply sped up the collapse of something that had already been fragile from the very beginning due to earlier strategic mistakes. The result was 61 stores closing at once. Things came to a head in 2014 when Starbucks sold its remaining Australian operations to the Withers Group, an Australian company with experience localizing international brands to succeed in the domestic market. What's remarkable about this story is that it doesn't end at the point of failure. The new owner, Withers Group, took a completely different approach. Instead of continuing to compete head-on with Australia's independent cafes, a battle that had already proven unwinnable, they shifted their focus entirely. Starbucks began targeting high-traffic tourist locations in major cities like Sydney, Melbourne, Brisbane, and the Gold Coast. This strategy targeted an entirely different market segment, not local Australians who already had their own favorite neighborhood cafe, but international tourists who were actually looking for the comfort and familiarity of a global brand they already recognized. And this strategy finally paid off. In 2023, Starbucks recorded its first profitable year in Australia, more than 2 decades after first entering the country. So what's the big lesson from Starbucks' story in Australia? Global success doesn't guarantee local success. Starbucks assumed that the formula that worked in the United States would automatically work everywhere else, without needing to adapt its menu, its expansion strategy, or its customer experience. This mistake bears a striking resemblance to another global business failure: Walmart in Germany. Just like Starbucks, Walmart also carried its American formula, unchanged, into a new market without understanding local culture, deeply entrenched competition, or local consumer preferences. Both cases prove the exact same principle: localization beats standardization. If you enjoy business case studies like this, don't forget to like and subscribe so you don't miss other case studies on global business successes and failures. See you in the next video.